Thanks for clicking! The government has released the technical details of its latest mortgage changes, which it is calling the boldest mortgage reforms in decades.
Is bold the right word?
Indeed, and the release of the mortgage details comes as Mortgage Professionals Canada took to Ottawa to tell the government what a great job they're doing.
To thank the government for the announcements that came out last week, first and foremost. It was a tremendous win, not just on behalf of Mortgage Professionals Canada and our 15,000 members across the country, but Canadians everywhere, from coast to coast to coast. First-time home buyers.
Well, Canadians everywhere?
Doubt it.
We've talked before on this channel about how the changes are being called a jackpot for the real estate industry, but what about for home buyers and for Canadians at large? And for that, to find out the extent to which extending amortizations is good for home buyers and Canadians at large, let's take a look at the data and the research.
What is that?
So what I want to do today is go over the technical details on these mortgage changes released by the government, take a look at what our own central bank has had to say about 30-year amortizations in previous research, and then discuss some implications. As we'll see today, the changes coming to the mortgage market do have the potential for a fairly big impact, and we will continue to track this story on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rules. Onto the technical data. As clarified by the government under the new rules, all first-time homebuyers with less than 20% down will be able to get a 30-year amortization, and all buyers of new-build homes, not just first-time homebuyers, will also be able to get a 30-year amortization with less than 20% down. The government also noted that it will not be increasing the sliding scale on the new insured mortgage cap, so borrowers will have to put 5% down of the first $500,000 and 10% of the next $1 million in purchase price, meaning you will now be able to buy a home for $1.5 million with $125,000 down. Looking into this a bit further, assuming a CMHC mortgage premium of 4%, that will be an initial loan amount of $1.43 million, or about a 95 loan to value. Assuming a decent 5-year fixed insured mortgage rate of 4.24, at the end of that 5 years, $132,000 would have been paid off, leaving a loan amount of $1.3 million, about 87 loan to value. What on earth could go wrong? In February of 2022, Toronto's benchmark price was sitting at $1.34 million and has since dropped $240,000 to $1.1 million.
Oh, nothing's going to happen.
Yeah, that's what the board said in February of 2022 when the benchmark was sitting at 1.34, noting that price growth would moderate in 2022. Meaning prices were still expected to go up. So now we have clarification on the new rules, though we're still wondering what the CMHC premium will be for a 30-year AM. But the question remains, will this be good for Canadian homebuyers and Canadians in general? Well, those are two very different questions. Let's start with Canadian homebuyers. On the one hand, yes, buying power is going to be increased, as we discussed on another video. For those currently able to buy the current benchmark priced home, they will be given an additional $40,000 to $50,000 worth of buying power. Given that Canadian home prices are still about 33% higher than they were pre-pandemic, I'm sure many homebuyers and those who earn their commission based off how much homebuyers spend will benefit, at least as we'll see initially, from the increase in buying power.
We're on the same team.
But it's not all good news. In 2021, the Bank of Canada found that increasing the amortization period to 30 years was associated with a higher probability of stress, and is also associated with borrowers stretching themselves to meet obligations. And this additional stress on homebuyers could in fact be a problem, says the central bank, as it eliminates flexibility should an adverse income shock occur. Meaning, if borrowers take on a 30-year amortization and happen to lose their job, they're already fairly far stretched. And the Bank of Canada doubled down on this notion in 2023, noting that while extended amortizations does allow for lower monthly payments, it also increases the period of household vulnerability as equity is built more slowly. The bank also discussed this back in 2022 when it noted that extending amortizations removes the option of re-extending the amortization should an income shock occur. So the bank for the past 3 years has been arguing that if we extend amortizations up to 30 years, less and less principal will be paid down during the first 5 years of a mortgage term, which will limit borrowers' options should a negative shock occur, in the case of job loss.
No way, never happened.
And for an illustration of this, we can turn to the Bank of Canada from as early as 2008. when it noted that long terms can significantly increase the cost of ownership, with the bank showing that longer amortizations lead to much more money going towards interest and much less going towards principal. And just a side note on this, the government is promoting these extended amortizations while the central bank and math point out that these longer terms mean Canadians will be paying much more for their houses, while the real estate industry and the government are trumpeting the increase in affordability. And you know who else does that? Car salesmen. Yeah, that's why every guide you'll ever read on negotiating with a car salesman will tell you to focus on the price, what you're really paying for the car, rather than the monthly payment, as the salesman tends to push the payment rather than letting you know what you're actually paying for that car, just so you're clear about what you're doing.
And you might be overqualified.
So, the inability of households to handle adverse income shocks, increased vulnerability, and an increase in the total cost of ownership, all being cautioned by the central bank in the period leading up to these rule changes.
I am looking out for you in this thing, okay?
Yeah. Now, just as another side note, the Bank of Canada's next press conference is going to be held on October 23rd, and Canada's media dilettantes will no doubt ask the governor 8 times about rate cuts. But for those who are allowed at these press conferences, can you ask the governor if he still holds these views? If the bank is still concerned about 30-year amortizations? Don't ask about the new rules coming down from the government, as the governor will no doubt say that it's not the Bank of Canada's job to judge the fiscal authorities, that it's their job to fight inflation, etc. Rather, just ask if the governor, if the central bank, still holds these views.
That's the reason why you were passed over.
But it's not just the Bank of Canada that has observed people taking longer to pay off loans may not be the solution for everything. A 2020 study looking at Canadian house prices found that mortgage debt drops when amortizations decrease. Obviously, that study doesn't find that increasing amortization will necessarily lead to an increase in mortgage debt, but those studies don't really exist, as we haven't seen amortizations increased for the past at least 15-20 years. So we don't really have any conclusive evidence one way or the other.
Don't worry, Scrub.
Further, let's just say, hypothetically, that we get widespread adoption of these 30-year amortizations, and house prices tick up, which Moody's is already warning about. If this happens, then that 30-year amortization could very well be a wash. It may not provide any additional marginal benefit for first-time homebuyers, but rather could be needed in order for first-time homebuyers to get into the market.
Not at all what I intended.
We saw this in 22-23 when prices dropped on rising interest rates. Then when it looked like rates were going down, house prices increased, and all the affordability gains that came with those rate increases were washed out. So for Canadian homebuyers, at least in the very short term, extended amortizations could allow for an increase in buying power. But a lot of risks are also associated with those longer amortizations, as have been warned about by the central bank for the past 15 years.
Yeah, well, that's over now. Gone.
But what about for, as stated by MPC, Canadians everywhere? Well, according to a 2023 study from CMHC, increased amortizations increase lender risk, as, which we saw, less principal is paid down every month. But, fortunately, or not, that's not really the case with insured mortgages, with the government backing these loans 100% if insured by CMHC and 90% if insured by one of the other 2 private insurers. So, as argued by Canada's central bank for the past 15 years, these loans carry with them a lot more risk into the system, and argued by Canada's own mortgage insurer, and these new risky loans are now being backed by all of Canadians.
Always got to help.
So, in essence, when the MPC heads to Ottawa to thank the government, they're not wrong, as the government is now backing the ability of Canadians to take on higher, according to the central bank, much more risky loans, which will indeed lead to higher commissions. As we saw today, these extended amortizations carry with them a lot more risk than do 25-year amortizations, as has been argued by our central bank for 15 years. Meanwhile, the government and the real estate industry at large is telling everyone that this is good for all Canadians, that this is good for first-time homebuyers, which may be the case at least in the short term, and good for Canadians at large, which, as we saw today, the powers that be, CMHC, the Bank of Canada, say may not in fact be the case. Now, all of this isn't to say that these 30-year amortizations are going to have an immediate impact on the real estate market. As we talked about in another video, Canada's economy is indeed weakening, and as of right now at least, first-time homebuyers are not maxing out on their mortgages. But, come longer term, we could see the fruition of some of these warnings as have been outlined by the Bank of Canada. With that said, these 30-year AMs are set to take effect in December, and we will obviously continue to track any changes to them on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.